You're listening to the Reinvest Podcast, where each Tuesday we show business owners and entrepreneurs how to diversify into real estate by equipping you with the tools and tactics to build generational wealth. Your hosts, Garrett Gatton and Seth Ciminillo. Hey guys, thanks for jumping on to episode 112 of the Reinvest Podcast. You know, I don't ascribe to be a college football enthusiast. However, in doing some context and some background for our guest today, I discovered that this individual is a Penn State alumni, which at the time of this release is kind of a painful conversation because we're in the Buckeye State right now. So, Mark, I don't know if you want to comment on that at all.
We were so close for the first time in years. The Penn State season ticket holder. Alumnus, go there for all football, basketball, ice hockey, wrestling, volleyball, everything they got, and it was painful for me to watch. So
well, if it makes you feel any better, Ohio State, you know, our MO is to do really well in the regular season and then absolutely fumble any kind of postseason presence. So I'm sure you'll get some revenge here in a few weeks.
And we all hate Michigan, so
yeah, we can agree on that.
We're all in this together. So,
well, Mark, thanks for coming on. Mark, you're the CEO of MBFS. Today, we're going to talk about credit unions, one of the best kept secrets that investors need to know for their real estate portfolio. Give us some context to who you are and why are you so excited about credit unions?
Yeah, I've been the CEO of MBFS for over 12 years now, and I've been involved with credit union business lending for over 25 years now. Back when I started, it was credit union business lending was a speck on the speck on the speck of the entire industry. And who we are owned by 13 credit unions and work with over 100 credit unions nationwide. And we have a team of lenders out there drumming up loans. And so to basically as their originator for the local credit unions, and we place them with the credit union the best fit. We're also the back office engine for credit unions nationwide that have their own lenders. We do all of their underwriting documentation. We service almost $3 billion in loans and commercial loans. We'll do everything from, you know, the 1 to 4 family units, small business loans, commercial real estate, to the person starting out up to, I think our biggest loan is about $40 million. So
wow.
we can grow with
no
people.
Small amount. Let's zoom out a little bit. Can you maybe describe what is a credit union compared to a normal lender or a normal bank? What is a credit union?
Sure. And my kids couldn't even answer that question, and they hear me talk all the time. So, over almost a third of Americans belong to a credit union, and you drive by every.
They don't even know it. I'm just kidding.
No, they don't even know it, or they don't know what that is. And if you look under the covers, what a credit union is. It's a not-for-profit financial co-op. So there's no owners of a credit union. It's run and managed by the people who have accounts there. They elect a board of directors who oversees the management. We are federally insured by the same government as a commercial bank, and we have the same depository insurance. So, and have many of the same regulations. So it's that, people put money in their account and that money is then lent out locally in the communities where the credit union has, where people are and for the needs of the community. So because we don't have that merger pressure hanging over us, the earnings per share, it is a cooperative. First of all, I think we tend to be a little bit friendlier. Nobody's out there picketing on the streets against their local credit union.
Right.
And we also can pay a tad higher in interest, keep the rates fair, and hopefully charge you a little bit less in fees. Because and I look at credit unions as taking that place of the community bank from 20 plus years ago.
Right.
it used to be, where I grew up, we had First National Bank of fill in your hometown.
Mm-hmm.
Those are gone. Those are gone, but they're still out there in the new version of that is the larger, more sophisticated credit union.
Now I'm gonna I'm gonna ask you to fill in my ignorance level of the financial kind of industry and the history of that. The building saving and loans crisis of 19 fill in the blank. I don't know when that was.
Yep.
Was that structure or model similar to a credit union? Totally different, related?
They were a lot of them were mutual savings banks, and what they were banks, and they were, I would call them a cousin. And what happened was they got really upside down in terms of liquidity and interest rates. And so they were not-for-profit cooperatives, and most of them converted to be true commercial banks, and they were much closer to that piece. But the Savings and Loan Association, yeah, that's what it was. Think about It's a Wonderful Life on Christmas Eve.
Yeah.
They had that it's what it was. It was that home and building association. People put their money in, and then it was lent out locally. A credit union, I would call, is the modern version of that, where we're not looking to build it for shareholders. We're looking to build it for the community.
So I think a question I have, so I'm a part of a local, I'm going to call it regional now, credit union, Superior Credit Union, and they're, Northwest Ohio, up and down I-75. Sounds like from what you're saying, credit unions still are very localized in terms of their comfort level doing loans that way. So if you guys belong to this, wider base of credit unions nationally, and we're talking about real estate investing and how those can be a competitive advantage over maybe other loan products, what happens when, I want to take a property, get a loan, but it's for a credit union that's not in my backyard? How are they going to feel about that?
Yeah, you just made my sales pitch, because the one nice piece about credit unions is they are cooperative organizations who also cooperate with each other. And if you think about us, we're a company where a bunch of credit unions get together to provide a service to people better than they could do themselves. That does not happen in the commercial banking industry.
Right. It's very cutthroat, very.
And so we cooperate on two different levels and bridge credit unions together in just that area. And the first is funding. You're with Superior Credit Union, nice regional bank, nice regional credit union. But if you came to them with a $5 million transaction, they could say, oh, we love you, but it's too much. So we bring credit unions together in participations and funding. The other very common piece of working with credit unions together is just what you said in terms of region. Let's say you found a great deal, a multi-unit in Indianapolis or Pittsburgh. We would say, okay, well, you work with us. We're going to match you up with, we already have all of your financials. We already have all your information, but we're going to match it up with one of our Pittsburgh credit unions. And you got the loan from them, but you're still dealing with the same organization. So really, you kind of have the power and scope of our entire network of credit unions, rather than just dealing with somebody who maybe they work in one town or one MSA. And when you're a real estate investor, that can sometimes be tough, depending on your business model. So we bring all of these credit unions together to make it easier for people to work in our industry.
I guess it would be kind of ironic if a credit union, which is a co-op of people locally in a community, was not a part of a co-op of other credit unions. So that's essentially what it is. Co-ops, credit unions are working together to be able to swing a bigger stick, stay competitive in a marketplace where there are private companies that are for profit. And this is a way for them to have a competitive advantage in the marketplace, is by co-oping with other credit unions. Is that fair to say?
Exactly. Your average credit union might be $300 million. So they might max out for you maybe $1.5, $2 million. But you love your local credit union, and this is a way that we just leverage the industry to keep everybody working together.
So
Because for us, they also don't have the ability to go build an entire infrastructure of a commercial banking department. So that's really their plus on using a company like us.
I think lending is such an interesting topic right now. People are watching some of the headlines of what's happening to regional banks, right? And a lot of them are commercial real estate loan heavy on their books. Depending on what the diversification of those commercial loans are, we've seen that it's put certain banks in distress, and there's been money. It's weird. I've seen this firsthand from operators who have large portfolios, and it seems money is going two places. It's leaving the regional level and either going to the big boy, right? First America, Chase, or it's going back into local communities and smaller lending institutions for that perception of safety, right? Are you seeing that happen? Are credit unions subject to those regional banks having some of those issues?
Yeah, and you'll see the big guys, the top 10, 20 banks, they have so many ways of raising capital that they didn't have the liquidity stress that a lot of people saw for the past year or two. And those regional banks are kind of caught in the middle of, they rely on deposits, which were slim. They're getting pressure from commercial real estate, which is going to be a train wreck for the big commercial real estate projects the next 2 years. Whereas the credit unions naturally have a diverse loan portfolio. They do a lot of cars, they do a lot of homes, they'll do residential, they'll do credit cards. So they don't have all of their eggs in one basket like the regionals or super regional banks. So the stability is much there compared to some of our banking competitors.
I want to bridge the gap for somebody listening to this. Okay, so this took me time to kind of understand. Seth and I always joke that like we're in real estate. We help people do this on a daily. We buy real estate ourselves. And lending seems to be this very mysterious, like unknown thing. Like, how can I negotiate? Like, is the interest rate the interest rate?
The rules are always changing, it seems like.
They are, and there's these provisions in a loan document that you don't know until you get to that point, and you're like, oh, I didn't even know that was a thing. So it's taken time to understand how lending works. And if you're listening to this, different banks have different risk tolerances, and their risk tolerances change for that lending institution depending on the kind of loans that they have on their books. And so, maybe in 2018, 2019, while this was happening, there was a bank regionally that was very aggressive on multifamily lending. They were doing 30-year amortization at a regional level. It was not any agency debt or anything like that. It was just a regional bank giving very favorable terms. So naturally, you're going to, double down on that when it's working. We had a property under contract, had a loan commitment from them for a 30-year amortization. We were 4 weeks out from closing, and they say, we've hit our saturation limit on these types of loan for multifamily properties. We're not going to give you a 30-year amortization. Instead, we're going to take a step back to a 20-year. Well, we just modeled this deal off of debt that was going to be paid over 30 years versus 20. So it sent us scrambling, and it showed me that banks are all like, things can change very, very quickly in the lending world. And you're seeing that happen. So I think this conversation is relevant if you're an investor to understand that certain banks they're retracting really heavy on loans and then being excited to do loans on commercial real estate. More in the commercial realm, right? Because the residential is more regulated and those loans can be sold on the secondary market a little easier.
Yeah, generally when in my world, a credit union will hold their investment properties. Mortgages, yeah, the credit unions are very active in the secondary market. Most of our properties, almost all of our properties will be held internally by the credit union. So what one of the nice things is about for every dollar of deposits, credit unions will lend out about 85 cents of that in loans to the local people.
Wow.
So they'll put that out there and they tend to be more consistent. And that's what I think if I went to a back to the banking world, I'd get fired. Just because credit unions tend to be more casual, consistent. We're not in a market and then out of it that you sometimes see in the banking world.
So give us some really practical stuff. Someone listening to this is a real estate investor. They're buying single family homes. They're holding those homes, small multifamily property. They're kind of scaling up as they grow in their sophistication level, or they're a small business owner. What products, what features of a credit union would be advantageous for them over a Huntington, over, a different bank?
Yeah. And I always like to say, so two of our best features, particularly in today's world, are the one of it is there's no prepayment penalty ever at a federal credit union.
Like, is that a mandatory law, or that's just best practice?
Can't do it if they wanted to.
Now, you said federal credit union.
Yes.
There's credit unions and there's federal credit unions, right?
Think about there are some state chartered and in Ohio, it's almost all federal credit unions.
Whew, okay.
So and even in most there's a few states that allow prepayment penalties, but that's a very narrow segment of
that's
our
huge.
world.
That's very huge.
So and nobody cared in 2021 when they were pushing out, 3.25% rates about prepayment penalties.
Mm-hmm.
But in today's world, you're going to see some serious swings.
Now, will that affect the pricing of the loans, knowing that someone could just come in and sell those?
No.
Wow.
No.
That's a big deal. Yeah, I just had a buddy who closed on a multifamily property with a credit union, and they did not have a prepayment penalty for him, and that was the linchpin for him to get that loan through that institution.
Yep. Yeah, and the other piece that, from a real estate investor, it's more about the relationship. We are not widget lenders. And you said Huntington, so I'll use Huntington. Huntington has a credit box. It goes into the factory, and it's either there's a machine that either says yes or no.
Right.
That is not the case with a credit union. It's much more, what can we do for you? What's your business? Where are you heading? And if you've had a bump in the road in the past or have a special situation that we have to talk through, what do you know? There's an actual person with a name that you can talk through to work through that. So I think there's value to that.
So Mark, you mentioned just now relationship, and I that was one of the questions I had. Is relationship lending still a thing in a world where there's big corporate America? My father-in-law, when he built his home, went to a local bank, had a construction loan opened up for him, and he was the general contractor for his own home, and he brought them plans and told them, I'm going to build this house. And he was a floor layer who didn't really know anything about home construction, but he gave them the confidence, and there was that rapport that they let that happen. His home is still standing. It's a beautiful home, but but you can't do that kind of stuff nowadays. No. So what do you mean that, like, you guys look at the relationship?
Yeah, and people who we always talk about the numbers, the deals, the amortizations, but at the end of the day, if we have somebody who's stuck with us, proven they're fiscally responsible, we'll do everything we can to bend over to make that work. So let's say you've had a job and you're going out on your first rental property. That matters that you've had that full service relationships. We see your deposits. We see how you've managed your account. We see that you've gotten a couple car loans or a mortgage and have investments and have that with us. Yes, that is a bonus. We don't look at a real estate analysis on an island. So that history does count quite a bit, because it's not some, far off department who's just saying, what's my LTV? Give me the rent. What's the cash flow? In, out. Thank you. Have a good day.
Like a DSCR loan.
Yeah. And also we have that multi-institution look to tell a credit union, oh, they're a member of this credit union. They've been solid and safe and stable, and now they have a property in your marketplace who they want to bring that to you. So undoubtedly that helps and assists and is a strong factor in what we do every single day.
Yeah, for your company, I mean, I see that as the biggest advantage. If we're here in Northwest Ohio, part of our credit union, and we had a multifamily property in another state, having someone that could make an instant connection for us is actually a really big deal when it comes to like these bigger commercial loans. And we've even seen a lot of outside investors, out of state investors, come into our area. And it is hard to get local banks to work with them. It just is. They don't feel good about them. They stamp them as some out of towner carpetbagger. Yeah. Well, and then they're buying these $30,000, $40,000, $50,000 investment properties, and these banks it's not worth their time almost. And they don't have deposits at the bank. They don't have local relationships. They don't have a local history. And so it's actually really challenging when you're going to a new market to find banking relationships that will take a chance on you.
Absolutely. And that's, credit unions talk to each other, and that is that plus of working with, not, you don't look at it as just working with, bank on the street corner. You're working with the credit union industry who will talk to each other and introduce them to each other. So
one of the questions that I had, just that we touched on it a little bit earlier, what is the biggest difference between a federal credit union and a regular credit union? Because we had the bank he was talking about, the credit union he was talking about, Superior, it used to be a federal credit union. And I don't know how many years ago they switched over, but now they're just a credit union.
Oh, wow.
Yeah. And sometimes so think of the top level, they're all credit unions, and they're all insured by the federal government. Of that, there are state chartered credit unions that are regulated by the state. And then there are federal credit unions that are still regulated by our national agency. So the state credit unions get federal insurance, but there's a state Department of Banking, a state Department of Credit Unions, and some states have more favorable rules. Some of them, the examinations are a little bit cheaper. Some of them, the field of memberships have a little bit more flexibility. So what you tend to, like in Pennsylvania, there's not much of a difference. In Iowa, there's a huge difference. In Florida, there's a huge difference. So almost everybody in Florida is the state chartered credit union because they have a little bit more flexibility.
Gotcha.
But they're all insured by the federal government.
So the answer is that it's nuanced from state to state, just depending on.
Yeah. In your day-to-day consumer, it's more of a governance issue than it is you would recognize any difference whatsoever.
So for MBFS, you guys work with both, you communicate with both, partner with both, or is it only federal?
We have federal credit unions, we have state chartered credit unions, and we actually have Puerto Rican cooperativas and their versions of credit unions. So if you want to buy a property in Puerto Rico, we can help you out too.
We have talked about it.
Actually, that's no joke. Literally, we were like, we had a podcast guest on that's from Puerto Rico, and he does some short-term Airbnb stuff. And after we got off the podcast episode,
we looked at each other. We're like, "Are we doing this? Are we buying in Puerto Rico right now?"
We haven't done that yet, but actually, that's super relevant because I was like, "How do you get lending on a property in Puerto Rico?" Oh my goodness, this is coming full circle. Well, I've got a lot to think about. Okay, question for you. Someone's listening to this. Okay, great. I recognize that the benefit of working with a credit union is the relationship. Now, how does someone establish rapport with a credit union? Is it I find a lender and I take him out to lunch every other month and he gets to know me, Or I'm like, what are the concrete ways that you can establish rapport that matter?
Sure. What I would say is in your hometown, and there tends to be that one or two credit unions in everybody's hometown. Stop by and open up an account. Put a couple $100 in a savings account, or check out their website and see if they're helping out businesses. Maybe you don't need something right now, but just stop by, up an account, put a couple $100 in a savings account, get on their email list, mailing list. And when you need something, yeah, you already have that. You already have that established. If you're not sure, where to go, contact us. We'll match you up with who's lending in your marketplace. Even if somebody doesn't have, even if we don't have a client in your backyard, we'll still match you up with a local and introduce a local credit union or a company like us that works in your marketplace.
Yeah, that's great. That was one of the big things that I realized too, from a local bank perspective in general, is deposits are kind of the lifeblood of those banks. And if you're always the the investor that comes in and says, roll out the red carpet and give me your best loan product, and they don't know you, and you have all of your deposits with another local bank, they may give you that in good faith to try and earn your business, something like that. But if you're ever wondering why there's a business owner or an investor that's getting really good loan products, it's probably because they have deposits at the bank in that long-term history. A lot of people don't realize that when a bank gives you an interest rate, it's Fed funds plus their spread. And that spread is what they want to make on that loan. And the more that they want to invest in that relationship, the more competitive they're going to get on that in those terms. And that was actually our experience in that scenario earlier, when the bank pulled the rug out from under us and said, we're not going to give you the loan that we said we were going to. It was a local bank that came to us and said, you know what, based on our relationship with you, we got loan approval from a loan committee to get something more favorable. So I want to emphasize, if you're listening to this, what Mark's talking about from a relationship banking side of things is really important, and you want to have those relationships in your back pocket.
Well, and even one practical example, just from my own experience. So I got my last loan that I got, or maybe, I think the last loan I got was with a credit union. And it ended up being a portfolio product of the credit union specifically. So it wasn't a loan that they were going to sell on the secondary market. It was for a residential property. But just the spot that I was in the relationship that I had with the bank, they were willing to put me in a portfolio product that still allowed me to get the loan. And so that was like one of those benefits of working with a credit union, working with local. It's definitely not a product that I would have gotten at a Huntington or a Chase or some of these just lenders, rinse and repeat. If you don't fit in their box, you're out. So just to validify everything we're saying. So, Mark, we're going to jump into our Smallerpockets segment. So go ahead, Mark, and tell us about a real estate deal that went wrong. If it's not in real estate, it could be in the lending world. What went wrong? And then most importantly, what did you learn from it?
Sure. We lend to retail real estate investors. We do people with hundreds of units. Most of our people, maybe they have a job or a part-time job and portfolio. And I'll take me as an example. I am the least handy person in America. If I fixed your toilet, you would not want to use that toilet. Okay. And my wife will validate that. And so what I find is that there's money people who outsource and get the support. And then we have handy people. So we had a portfolio. I think the guy had about 10 units, and he was pretty handy. That was his job, a contractor type of guy. Couple kids, wife, couple kids. So he has a vasectomy. And it is a botched vasectomy.
No. Oh no. That's not one of the surgeries you want botched.
That nearly cripples him.
Whoa.
Cannot even hold his kids in his arms. Okay. I can see the cringe on your face.
Yeah. Any guy listening to this would cringe, let alone where we know this is going.
So he can't work. Okay. He can't keep up with his properties. His properties were like mid-level, needed maintenance. Couldn't keep up with it couldn't work. So it just snowballed from there. Starts having stress and couldn't keep up with the maintenance, couldn't keep up with anything, all because of a botched vasectomy. We end up taking everything back.
Oh,
Wow.
no.
It set him back that much that
He was basically crippled them overnight. Couldn't work, couldn't get out, couldn't collect rents, couldn't do anything, couldn't fix up the properties when he needed, and it just was the ultimate snowball. All over a botched vasectomy.
So do you know how it ended for him? Is he recovered?
He ended up it took years for him to recover.
Oh, my word.
oh my goodness.
And we took a bath on the properties because of deferred maintenance. And really it's having when you're the labor behind your units is to have that backup.
Yeah.
How can you and he was a working class guy. He worked, he supported his family, and the properties were supplemental to that.
Right.
Mm-hmm.
But insurance is key. You know, he didn't have also any disability insurance. You know, hey, I got properties. You know, I have units and they pay me every month, but didn't have any sort of disability insurance. You know, and so people should think about their life from a life insurance, from a disability insurance, to have the backups, to have the resources, and factor that in, and not have just this will always be just fine because I can always do it, because it can just think about you and your family.
Yep. We did an episode, I don't know, a couple months ago or something, that was like, run your real estate business like a business. Yeah, and we talked about that, and we're like, hey, if you want to do your own maintenance on your properties, that's great. You know, save some money. You're young, you're hustling, but you need to structure your business and your portfolio to where you don't have to do that, because otherwise you don't have a business, you have a job. And to your point, it leaves you super vulnerable. So, you know, if you're out there and you're doing your maintenance, it's like, man, maybe be thinking through, what is my contingency plan if, you know, something like that happens. My lesson from that story was don't get a vasectomy, though. So that's what I got out of it.
Mark, I have 6 kids, and I already know for a fact that if I go to you to get a loan, your first question is going to be, do you have any planned surgeries in the near future? Yes. All right, that was a good one. You know what? That's going to be the podcast title. It's very clickbaity. Botched vasectomy.
Yeah.
Find out how. We'll probably have a lot of listens on it. We're going to go into what we call our little nugget. So, Mark, this is part of our show where you give our listeners a practical takeaway or piece of advice that they can implement to their real estate investing businesses.
And what we always tell people is learn, educate, but stick with what you know. Stick with what you can manage. The number one reason we see portfolios have stress is because they grow too fast. They think one property is great, 100 properties must be better, and they don't treat it like a business to scale and grow, and it gets out of their hands. If you want to go to a new market, learn that market, know that market. Just don't go in and say, I think I have a deal. And, you know, the price is the price for a reason. So if it seems like a great deal, there probably is a reason it's a great deal, and you have to learn and understand that marketplace.
There's a company that there was an investor in our area who had hundreds of units, low in, like D grade single family houses. Sold them all off, 4 or 5 years ago, pretty much. And there was a company out of Florida that came in, and that's what they did. They saw the numbers, they saw the cash flow. They're like, this has to be a great deal. And they bought, how many units did they buy?
It was like 86.
80 units or something. Didn't have anything else in our area. Didn't have relationships in our area, nothing. And for the last 3.5 years, they have been struggling.
We went to a property and talked to a tenant, and they were like, I haven't
paid rent in months.
Yeah, right. And that was the story. But to your exact point, it looked great on paper. The thing about a real asset is it's a real asset. Like, it's a physical thing that needs to be managed and attended to.
And the price was very prudent. The price was the price for a reason, because they needed a ton of work, and it was a hard tenant demographic, and they're still struggling. I mean, they're still trying to figure out a way out of it and probably try to retain their money. So,
Mark, I'm excited to ask you this question. Reading your bio, some of the positions that you've stepped into over your professional career, you were able to do some really cool things and kind of right the ship and grow and excel those things. That doesn't happen by accident. One of the questions we ask all of our guests is, what has been one of the best resources in your business development? Just knowing that you've stepped in and done some really cool stuff, what's been one of the biggest resources that served you well over your career?
Yeah. And here in MBFS, I stepped into a role where I was the 5th CEO in 5 years. It never made a dime, lost money every single month. And we've grown it to be quite a powerhouse in our industry. And it was nothing to do with business lending. It was leadership skills. It was organizational skills. It was talking to our customers, understanding those customers, and reacting to our clients, instead of me bulldozing over and saying, this is who we are, this is what we're doing. It was really listening to our industry, listening to the customers, and talking through the marketplace, as opposed to thinking that I'm the smartest guy in the room.
So humility.
That's a awesome. novel concept.
Well, I think, even someone on our last episode was, the way they answered that was other people, right? And so, you've got 2 eyes, but here there's 6 eyes. And so, we can lean on other people's experience and take that posture of learning versus kind of overlaying my 2 cents. And I've always been struck with the maxim: if you want to go fast, go alone. If you want to go far, go with other people. And that truly, I think, is tried and true. Mark, what would it look like for people to connect with you, find out more about what you guys do?
Sure. One of the easiest ways is markritter.com. You can connect to all the businesses on there. Our website is mbfs.org, but I'm also really active on LinkedIn. You reach out to me on LinkedIn, we'll react and connect when we can connect with you with a credit union or a company like us in your area.
Well, personally, and Seth and I say this all the time, we benefit the most from these podcast episodes. And so we'll absolutely be reaching out to get more information as we continue to buy property. But thank you for coming on and unveiling kind of something that a lot of people don't realize that's operating in their community, which is credit union. So great stuff today. Thank you. As always, excited that you joined us for another episode of the Reinvest Podcast. If you want to learn how you can use your hard-earned capital to diversify into real estate, go to our website, reinvestcapital.us, and shoot us a message. Move farther, reach higher, and grow deeper.